other than that, it's really my opportunity to thank you all for participating and to hand over to Barbara Domain-Hayman, who is going to chair and lead your first panel. And there's nobody better to do this. Barbara, you've been in this space for many years. You've seen many successful companies rise from the UK ecosystem, and they're in very good hands with you and the panel here on the first session on non-dilutive funding. Over to you.
Well, thanks so much, Stephen. Thank you very much indeed for setting the scene so well, and congratulations on the biomedical catalyst funding, which I mean the BIA did a fantastic job of lobbying for, and I know that that Perry is going to be talking about that in his talk. So welcome everybody to our session to talk about what to look for in pre-seed funding. So first of all, we are incredibly lucky to have three brilliant panelists. So I'm just going to say a little bit about who they are, but I'll let them introduce themselves more when they actually speak. So we've got Pam Garside, who is an extremely experienced angel investor from the healthcare perspective, and she's worked extensively in the UK and the US in healthcare, so has incredible experience. We've got Claire Turlow, who leads the LifeArc venture side of things. And Claire has amazing experience, having previously been at Syncona and having a deep background of corporate finance from the city. And we've got Perry Guess, who's going to be talking to us all about grant funding, which is obviously such an important area for early stage companies. So we're extremely lucky to have a panel. Just to introduce myself, I'm Barbara Domain-Hayman. I wear a variety of hats in the early stage sector. So I'm Chief Business Officer of a company called Tiffany Therapeutics. I'm also entrepreneur in residence at the Francis Crick Institute, where I lead a program called KQ Labs Accelerator, which is for data-driven health startups. We bring 10 of those through every year. We're actually doing a short session at 3 o'clock this afternoon on the Swap Card platform, if you'd like to find out more about it. And I'm also involved in a couple of seed investment funds. So without further ado, to introduce the theme of what to look for in pre-seed funding. Now, this is a very interesting area because the definition of seed funding has evolved considerably over time. And actually seed now can be really quite big. It can be many millions of pounds. So what does that actually mean in terms of pre-seed funding? Well, pre-seed funding is really the funding that you all need to start off, to take the first steps and do those key experiments to get that initial proof of concept that will give investors enough confidence to come in and invest at the seed round. So that's really what seed investment is, pre-seed investment is. But there are no hard and fast, there are no scientific definitions of what it is. So what we're going to do first is we're going to do a very quick poll to the audience just to see where you all are in your funding journeys. And as we said, there's no hard and fast definition about this, but what we did want to do is get a sense from the audience of, are you at the ideas stage? Are you at the initial discussions where you've had some initial conversations with investors and maybe they've expressed interest, but they haven't actually put the money in yet? Have you actually had money in which case, is it, and we're just putting an arbitrary figure in the poll, is it less than £100,000 or more than £100,000? That is not the definition of pre-seed funding. It's just to give us a sense of who we've got in our audience today. So Sam, if you could put the poll up, that would be great. So just give people a minute to vote. So are you at that ideas stage? Have you progressed beyond that, actually engaged with investors, but they haven't actually put the money in? Or have you actually had money in? Perhaps it's from friends and family, or perhaps it's from an angel investor, or perhaps you've raised more. So if you could, how are we doing on that, Sam? Have we got everybody more or less polled? Perhaps we can put the results up. Right. So that's very interesting. So actually we have quite a spread, but with the largest number of people either having had initial discussions with some commitments from some soft commitments from investors, and then we also have some people who have raised over £100,000. So that's a good spread of people in the room. Fantastic. Great. Well, what we're going to do now is to hand over to our panelists. So our three panelists are going to speak, Pam first, then Claire, then Perry, for 10 minutes each. Then we're going to have Q&A. So please do think of the questions while the panelists are speaking. Put them into the Q&A, and then we'll actually answer the questions at the end when we do the Q&A. So thanks very much indeed, and over to Pam.
Thanks, Barbara. Hi, everybody. I am an investor in mostly digital health and tech-enabled health sort of service delivery companies. I overlap with Barbara's area of bioscience and life sciences, but that's principally what I do. And I got into it by accident. I'm an accidental angel investor because I was a hospital manager here and health systems manager here and in the US. And I'm a member of Cambridge Angels, who are all sort of very deep tech. So in looking for, in considering pre-seed, I invest small amounts, so I'm of necessity at the very early stage of companies, right? So I'm often meeting people like some of you who are just at the ideas stage. More often they've formed a company and they're looking for very early money. And that's when people like me want to get in because the valuation is low, because we can't participate when the venture capitalists come in later on. So what you're looking for is that the founder and the founding team is the most important thing. And you're going to say, well, yeah, but what about the idea? Secondarily, it's the product or service, and then the size of the market and how sensible, and whether you feel this KIC team could develop the product or tech or service and service that market, and whether it's sensible. For instance, in my case, I get a lot of people saying, and then we'll go to the US because that's the big market, and they haven't thought it through. So those are the things we look for, partly because there's nothing else to look at. There's no track record, you know, in terms of revenues made, etc. We also look for, well, I look for, have you been on accelerators like KQ Labs, some of the other ones? Have you got grants? And I know we're going to hear more about that later, about Innovate UK, that sort of thing. We also look for EIS in this country, which is Enterprise Investment Scheme, or SEIS, even better. So we as angels get tax breaks. That's very important to people. So we're looking at all that mix. A lot of us are seeing a lot of decks. We get many approaches, solicited, unsolicited, referred to us. So remember, we're going through lots of stuff. And of course, because of my theory of meeting founders, we're often meeting founders and, you know, spending days on Zoom calls. So when you're flipping it to you, when you're looking for pre-seed, apparently I'm something called smart money, which some young colleagues in the States christened that 10 years ago when I put money in their company. And that's when people like me would potentially bring knowledge of how health systems, reimbursement, regulation, and government work. In other cases, some of the, like Barbara, I would say, brings a huge life science experience. So it's great to get smart money if you can, that people will invest and then help you. You could also say, go for some easy money, like the number of companies I've got whose parents and relatives and friends put money in at the beginning, not all bad, because they would generally be quite friendly to you. My second tip is be persistent. If people don't answer your emails, which I'm relatively responsive, but just keep going, because persistence is a good thing in a founder. I mean, don't completely annoy people, but be persistent. If people don't follow up with you, get back to them and say, look, I'm really keen, I'm really energetic, I want your involvement. On the other hand, try not to get to look desperate. And I'm afraid I feel that the sign of desperation is going for crowdfunding. I don't like crowdfunding myself. I don't like the crowdfunding platform. Sorry if there's anybody out there. And it looks like you'd be willing to take money from anyone. Even if you're feeling kind of desperate, don't let it show. On the flip side of that, there can be a feeding frenzy at pre-seed. A feeding frenzy, by that I mean, you are oversubscribed for the amount that you're raising, and that people sort of get this FOMO thing. Oh, we've got to invest in that. So-and-so is. And there's another thing there is that we tend to talk to each other as pre-seed and seed investors in certain sectors. So we don't have big staff to do DD on a company, but we'll ask everyone else and people start to talk about it. So if you can create a feeding frenzy, that's great. I think in later talks, people are going to talk about how much money you raise, because often people like me saying, are you raising enough? Because it takes a lot of time to raise money. You'll be spending your entire life raising money if you don't raise enough. VCs are, venture capitalists are coming nearer and nearer to seed than they were. The definition of seed is becoming fluid. So venture capitalists like to talk to people like us, so they want to know what we're looking at. And they'll want to then, if we invest, when we invest, they track what's happened, so they may come in the next round. So you may think you shouldn't approach Octopus Ventures or whomever. They're big in digital health, so I know them quite well. There's clearly other VCs that are more appropriate to your company, whatever it is. But don't just ignore them thinking they'll come in later. Try and cultivate any contacts you could have with VCs as well, even though they might not come in at this round. So I think that's pretty much what I would like to say, and I've finished early. Sorry. Barbara, you're on mute. There we go.
On mute. Thank you very much indeed, Pam. That was really interesting introduction to how an angel investor looks at the world. So thanks very much indeed for that. And just again to repeat to the audience, do ask your questions, put them into the Q&A, please, rather than the chat. So over to our second speaker. So Claire, over to you.
Great. Yeah, thank you very much. So I'm Claire Turlow, I'm Head of Ventures here at LifeArc. Thanks for having me on the panel. Very exciting. I just want to talk for a second about LifeArc, because I think LifeArc is going through a pretty major change, and I think that it might be interesting just to have a think about where we are now in terms of our journey. So LifeArc itself is a self-funded medical charity. I'm not sure, hopefully everyone can see this all right. I'm trying to put it on the big screen, but failing at that, I think. And our work is really focused on translation and moving medical innovation towards patients. So this last year, we deployed about 56 million into early stage translation. We have about 200 employees in 3 different sites. So we're operating between the early research, translation and development pathways. And again, we're focused on really defining and moving forward those things that can benefit patients. So we have 3 different services that we provide. We're providing translational advice, translational science itself in our labs, and funding, of course, which is what I'm here to talk about. And in 2019, we monetized part of our royalty rights to Keytruda for just approximately £1 billion. So the balance sheet of the charity is fundamentally transformed. And on the year following that, last year in 2020, I joined to help think about a strategy for investing further and expanding our work in financial investing in early stage translational research. We also support a number of charities. You can see some of them here to help them progress their research across our 3 sites. So what do we want to become? We want to be a major charity by 2030 and increase the work that we're doing along with many strategic partners. So we're expanding our work there. We want to grow what we're doing in diagnostics. We want to continue to work in advanced therapeutics, and we're keen on exploring how we can do this in a data and AI enabled way. So we have an existing funds, a number of funds actually. We have a philanthropic fund, which is providing grants. We have an existing seed fund, which was currently capitalized at £25 million, which has been investing for about 2.5 years. And we're expanding, as I said before, we're expanding our work here, and we expect to be able to deploy more funding into pre-seed, seed, and early venture investing, and we'll be able to say more about that this summer. And lastly, just to say that we are, of course, very actively involved in responding to COVID-19, and we've already committed more than £12 million into helping to fund some repurposing studies and various other grants. So we're working hard on the issues that matter to people these days. So in terms of what I'm keen to talk about here, as I mentioned, we're going to be expanding the work that we do in funding. we have a huge number of programs that we fund throughout LifeArc. We fund some work at the CRIC, at the KQ Labs. We're funding some gene therapy innovation hubs. We're funding co-development research with a number of charities. We're involved in a substantial number of funding programs. And through those programs, we see really, really exceptional science coming through at a very early stage through some of the UK academic centres. And we're really, really excited about the opportunities that we see there. We also fund companies and ideas that exist external to LifeArc. And so part of our work is trying to define how those opportunities align with our charitable missions and objectives. So the challenge for me on my side of the business is, you know, we exist to generate financial returns to feed back into the charity's goals to be sustainable over time. But we have the challenge that we need to ensure that we're investing along with those charitable aims, and that we are clear about what patient impact we are trying to generate alongside of the investments that we make. And that's, as you know, if you've come across the dynamics that you see out there in terms of how to measure patient impact, that's an incredibly challenging place to be. So we think a lot about those things. And that makes the work really fascinating, actually, because it's a different way of looking at how you invest. But ultimately, you know, our job is to sit in the ecosystem and to work with lots of other investors, whether they're the high net worth specialist angel investors, as Pam said, family, friends, through to the venture community that can scale up our investments. We're looking for where we can step into the gap in funding in the UK, and certainly that gap seems to be very obvious in the pre-seed and seed funding area. So we're keen to do more in that area. And I think due to the weight of capital that exists at the moment in healthcare, I agree with Pam that the bigger investors are moving earlier and earlier into the very early science. And so if we can be a portal or a conduit for that science to stress test and to do the killer experiments and to move things to proof of concept, then we've really helped to bridge that early translational science to get it further towards that step of being something that the big scale up investors would be interested in. So that's what we're focused on. And I look forward to discussing that a bit more in the Q&A session.
Thanks very much. That was a really clear explanation, and obviously LifeArc very much watch this space. It's really exciting developments in terms of funding early stage companies in general. So we just had one question, and it's great to see the questions coming into the Q&A. So thank you to the audience for that. We're going to take them at the end, but there was just one question which I think you might want to answer now, which was around LifeArc areas of focus. So the question was whether LifeArc just does rare disease apart from COVID. I thought you might want to just address what areas you focus in right now.
Yeah, that's a very good question. No, it's not just rare disease. In fact, we're going through a process internally where we're looking at other areas that we'll be focusing on for the next few years. But in general, it's across the entire very early translation spectrum, and it's not aligned with a specific therapeutic or disease area. Although in the philanthropic fund, we do fund quite extensively in rare disease. So I wouldn't be put off, certainly on my side of the business, if you are looking for very early stage funding, what we're really focused on is, does what you're doing actually make a difference to patient treatment and and impact the lives of patients, versus, for example, something which may provide the worried well with information, but may not necessarily change the course of treatment, for example. So it's really about, are you very clear about the impact of what you're doing if you were successful on the lives of patients? And I can go on about that for a while, because quite often we do sometimes have people present where they present really fascinating science, and they talk about being able to do something that hasn't been done before, but you're left thinking, well, so what happens then? Just because you're doing something that hasn't been done before, you need to make the link between that and actually how it will impact patients' lives.
That's great, Claire. Thank you very much indeed for that further explanation. Moving on to our third speaker. So Perry, over to you to talk about non-dilutive funding.
Thank you, Barbara, and thanks everybody else for your time. Really interesting here from Claire and Pamela as well. It was really interesting background. So I'm coming at it from a slightly different angle. I work for a company called Ixion in the innovation division. We're a not-for-profit owned by a charity, the Shore Trust, one of the largest charities in the UK dealing with disadvantaged disabilities, social injustice and such. The innovation division is a subtly different part of that. We don't deal with just innovations that are associated with that area of the charitable activity. We're actually technology and sector agnostic, but we're about transforming businesses to enable them to achieve more. And the primary way we do that is by helping them navigate the complexities of grant landscapes, and also then making sure that they can create very compelling propositions by actually preparing them for them as well, because grant proposals take a long time to get right, and there are some nuances which we'll touch base on later. In terms of me, my background, it's great to see you. I'm actually the head of partnerships at Ixion. I've been at Ixion for about 4 years. Before I was at Ixion, I was at the University of Exeter, and then before that, I was actually a funder myself. So I worked for the Natural Environment Research Council, where I worked alongside the likes of Innovate UK, the Medical Research Council, and all the other research councils under the guise of the UKRI right now. So I know very much what the heart of the politics behind grant funding is, and I can bring that to the table as well when we're looking at the funding that's going through. Before that, I actually ran what was one of the knowledge transfer networks, the KTNs. So it's all about, as the BIA, it's all about that getting together the great science, great businesses, and making a difference. And it shines very much along with what Pam and Claire have been talking about in terms of investing in things that will make a difference. And Claire, your final thoughts there about impact, the so what factor, that is so important in the grant landscape as well. So why grants? What's important about grants? It's something to be talked about. Well, the reason we do this is because grants are massively powerful. They're non-repayable, they're non-dilutive, and you get to keep the intellectual property at the end of the day. So it's an incredibly powerful part of your portfolio of funding opportunities. They can be significant. You can get them from £25,000, which it's a lot of work to go through for £25,000, but they can go through from that all the way to multi-millions, 5 million plus, etc., depending on where you're at. They're extensive. They can cover almost any stage of activity in terms of early stage concepts, proof of funding, proof of principle rather, feasibility, prototyping, commercialization, all the way through. And actually it's getting a bit more blurred because this thing called blended finance now, where actually there's grant money that is allied to equity finance. So it's even taking you into the commercialization domain as well. So there's lots of opportunities out there. Grant funding is really important from a perspective that it actually allows you to do things because, as I said, non-diluting, non-repayable, allows you to accelerate what you wanted to do, but it also gives you the chance to do something you never thought was possible because it's a grant to do something. You thought, gosh, now I can do something that I didn't think someone would invest in. One huge thing that many people don't always recognize is the kudos that grant funding gives you. This is government money, this is taxpayers' money, this is your and my pocket money going in to make a difference. And when you've been through the process of being evaluated by peers and the evaluation community, and then you've obviously got it approved by government, that can be huge kudos, and it really counts. Pam, you mentioned earlier about the fact that you like to see people with grants. It is, for want of a European term, a seal of excellence, that what you're doing is making a difference and is important. Another thing that's really useful is the fact that it's hugely complementary to other forms of finance as well, because it helps you de-risk. Theoretically, grants are all about doing something that no one else will afford. No one else can put their money into their pocket for. It's covering that gap whereby the technical risk is too big, the challenge is too big. So you have to, no one else will look at funding it. The lines are blurred, but essentially that's the point. In terms of the types of funding that are out there, there is a myriad, and I'm sure folk have looked into this and been slightly baffled by it all. There's just lots of different types of grant funding out there. But the way we cut this cake is into two different ways. We call them grants that will overcome technical challenges. So the proof of concept, feasibility, up to your prototyping. So that's overcoming technical challenges. Will it work? Can it work? Is it got a chance of doing something? And once you've proven that to prototype, you then get into the second phase of grant funding, which is all about commercialization challenges, overcoming the commercialization. And a simple way of saying it, perhaps not so connected to the medical side of things, but it's if you've got a prototype, how do you make that prototype fit for purpose? How do you make it correct for the market needs? How do you shave off those edges that are too sharp? How do you make it work through continuous improvement, through demonstration and such? That's the commercialization phase. So there's those two types of funding. On top of that, then there are two ways to access funding, in so many words. There is top down, where the government has set out a requirement in scope, and they're scope driven. So Innovate UK, the custodian of many of the fundings that go through to businesses, certainly in the UK. There are others, obviously, Wellcome, etc., and NIHR, to name just a few. But in essence, they're in charge of what's called the industrial strategy. And within the industrial strategy is the industrial strategy challenges. And within there, they have these certain areas where they require funding to go through. And in fact, the one we talked about before, the biomedical catalyst, fits snugly within what the work that's going on there. But you have to fit to the scope of that fund. And if you don't fit to that scope of that fund, clearly you can't apply. So the chances of your success of applying for a scope-driven proposal is higher, because you're not against other things like aerospace or environmental technology, for simple example. The problem with that kind of stuff is, and I was really pleased to hear it was talked about by Steve earlier, is that you never know when these scope-driven calls are going to happen. The UK government is terrible at making a forward plan as to when things are going to happen. Dare I say, the Europeans have got it a little bit better. Horizon Europe is now live, which was the next version of Horizon 2020, and they set out their stall, so you kind of know when something's going to come down the line, and you can start to prepare your consortium to bid into it. But the UK hasn't quite got that. I really wish it was something that we changed in the UK, but there you go. So the opposite to scope-driven calls is open calls, whereby you can submit a proposal to from any different walk of life, any sector, any technology area, but you're up against all different walks of life as a consequence. The plus side of this is that you know when they are, they're fairly regular. Things like the Innovate UK Smart Grants is a good example, where it's pretty much regular every quarter. You can bid in there up to £500,000 if you're a single company, up to £2 million if you're a collaboration, for simple example. So there are ways of doing that, but you are up against other competition, so your chances of success are reduced as a consequence. So that's the playoff between those two. Conscious of timing, I'm going to move on, and in fact this is one of the key things, is the considerations about grant funding. Timing. In your portfolio of finance looking forward to the future, you've got to consider grants as a really important part of your roadmap, but they aren't for tomorrow. It takes a while to prepare a proposal. It takes a while for that proposal to be evaluated, and it takes a while to you then contract negotiate with the funders to get that money. And typically from the deadline through to the start of the project could be somewhere between 4 and 6 months. So it's not money for tomorrow, but it's certainly a strong investment opportunity for the future. So you need to put that into your thought processes. Another thing, big consideration, is match funding. You never get, typically, rarely rather, 100% of this. Some funding mechanisms do provide 100%, and they're very good to go for, but standard is around about 70% for small to medium-sized enterprises. So you have to find the match funding that goes with that. So you don't have to say exactly where it's coming from, but it's a consideration. It can be from other investment, it could be from your own monies, revenues, etc. But match funding is an important consideration. And company size, something we thought might come in a Q&A, so I'm just going to deal with it now, is company size, your ownership. It's really important that you stay within the boundaries of a small to medium-sized enterprise, because that's where the highest levels of funding are. That's where you get 70% plus. If you're owned by another business in share ownership beyond 25%, you assume the size of that company if that's a large enterprise. So it's important to make sure that if you are being owned by others, you keep yourself below that number if it's a large enterprise. Likewise, within equity investment, it's got to be below 50%. Otherwise, you assume of a single company, equity investor. Otherwise, you assume the size of that single company. So we've had clients in the past where we've been looking to help them prepare a proposal, but they've been owned by giant equity investment houses beyond 50%, and they just can't qualify for the funding. So it's just an important consideration. One final thing, Barbara, because if I may, because the others were less than their time, is what makes a good proposal? Now, I'm sure this chimes with much of what Pam would be looking for, much of what Claire would be looking for, but certainly something when we're creating proposals for people, when we're writing them, it's really important to think through this, what we call our logic train, is the problem that you're trying to solve. What is that problem? How big is it? And forgive the terminology, but does anybody care? It's really important that it's such a crucial thing to think through is the problem I'm trying to solve important? The second part of that is it's got to be an unmet need. It's the fact that actually no one else is servicing this opportunity right now. Government money, and I'm sure much investment money, doesn't fund a Me Too because there's no need for it. It's already in the marketplace. And this is so important in grant funding. So the uniqueness and the disruptiveness is something really to bring to bear when you look at this. They like intellectual property because it demonstrates you've got uniqueness in there. Back to what I said, technical challenge and risky. If it can be done easily and it can be, there's not a lot of risk, there's not a lot of point in putting taxpayers' money into it because there are other ways of finding that finance. Dream team, again, something we might talk about later. As Sam said, as Claire and Pam have hinted to, the people are the important part of innovations nowadays. Grant funders look through the equity lens as much as they do through the grant lens. So team is important. Good business plan, routes to market clearly, value for money, and most importantly, a good read. When you prepare a proposal to the funders, simply the same as when you're doing a pitch deck, it's got to be convincing, but a really good read. And that's what we bring to the party because we've written a lot of these things in the past. And it can be wooden trees for entrepreneurs. How do I convey this brilliant information across? Finally, it was already mentioned by Steve, so I won't make too much of a meal of it, but I was really pleased to see the Biomedical Catalyst launched. It's a significant opportunity. It's £18 million in the pot. You can get funding for early stage and late stage activity. All the details are, of course, available online. It opens on the 7th of June and closes on the 26th of August. So it's a good amount of time to get your thoughts together on this one. It's mostly associated with disease and combating disease through prevention and management, early and better in detection, and tailored treatments. And you can go in for funding between £250,000 and up to £4 million. So significant sizes of cash could be at grabs here. Clearly, you can be collaborative in that space. Projects between 12 and 36 months, and it is the golden 70% you can get in this as well. So I hope that's useful. Sorry, Barbara, I've used up everybody else's unused time, but I hope that was useful.
Thanks very much indeed, Perry. No, we're doing fine for time. So thanks very much indeed. The grant landscape is so important for early stage companies to really understand and to get stuck in and have a go. So I think now we're going to have hopefully an interesting and lively Q&A discussion, and we've already had some great questions from the audience. So we can start off with those. But just before we do that, there are just a few questions still to LifeArc around specificities of what investment that you do. So Claire, there was a question about, would you do repurposed drugs, or would you only do new drug development? Would you consider manufacturing solutions? And do you have any geographic focus or restrictions?
So on the last point, we don't have a geographic focus. I mean, we're a UK independent medical charity, and we have an extensive network that we're funding in the UK. So the preference would be to continue to fund heavily in the UK, just because there's just so much opportunity here, right on the doorstep, basically. So, but if we saw something that was exceptional outside the UK, of course we could consider that. On the point about sorry, what was the I should have asked the first one first, and then I wouldn't have forgotten the middle one.
Around repurposed drugs.
Oh yes, yeah. So I do have colleagues who are working heavily in repurposing. So and certainly we've launched a number of conversations publicly about that. So LifeArc as a whole is interested in that. I suppose on the sort of financial investing side, we're less so, but I can always point you to colleagues who have an interest in that. So don't hesitate to reach out. We can find the right person.
And manufacturing technologies?
Manufacturing technologies, that's a good question. We don't have a heritage necessarily in that area, but we are, as I said, supporting the gene therapy innovation hubs, and we do have an interest in innovation in technology. So the answer to that is we're not therapeutics focused, and we are looking to do things that are new and different and can accelerate the development of treatments for patients. So there's no reason why we wouldn't look at that.
Great. And last question, which is specific for LifeArc, and then we're going to move on to a more general discussion. There's a question around LifeArc's work to support COVID-19, and what are your future plans on that score, and how do you see antiviral therapeutics development for the next few years?
Oh gosh, well that's a question for our head of therapeutics actually, but we have done an extensive amount of funding in COVID and moved very quickly last year to get funding out. And so I think the team that did that here, I know they worked night and day to get that money out into the hands of the people that are developing new potential treatments or repurposing, etc. So that's still very much high on the agenda. We are looking at other ways. We're always continuing to look at other ways that we can support the development of new treatments for COVID. And we're still funding in that area. So I think that we would heavily consider any new opportunities to fund in that area, both in terms of the grant side of the business and in terms of the seed and venture side. We have an in-house team of scientists who are extremely well versed in what's out there and who's working on what, because of all of the funding proposals that we've reviewed over the last year now. So I think we've got a good understanding of the network, of the competition, who's doing what, and it remains a top focus for us. So if anyone's working in that area and they have some new technology and new thoughts about antivirals or otherwise, please do approach us. And if I'm not the right person, I'll direct you to the people, the team in-house that are working on that.
Great, thanks very much indeed, Claire. So moving on to some of the other more general questions. So I think there have been some questions around basically, how much money should one raise? How much are we talking about? And I think this is an interesting point, because it's not really about how much money, it's about what you want to do with that money, and what is the value that you can create for that in order to create more confidence that you get the next investment in. So, would our panelists like to comment on how much money should you be thinking about raising, and how to create that initial value? Pam, do you want to start with that one?
It's slightly different in health tech in my area. It's slightly different from life sciences in that we don't have to do human trials and first in man, and the long schedule of investment needs. It's as long as a piece of string sometimes, and it's like the valuation decisions. So I've said before very briefly that often we think people are not raising enough money because founders don't realize how much effort it takes to do a funding round. And it's a massive effort, and it diverts you from your primary purpose of building the company. And I would say pre-seed and very early stage, often I see in the health tech 250, 500K. And then, but if there's additional interest, founders often push up the limit. And of course, then you've got to think about the valuation, which is an entire other discussion. It's not terribly scientific. Am I allowed to say that? Valuation?
Yeah. Let's come back to valuation.
Yeah, but yeah, that's my answer for health tech.
Right, great. Claire, in terms of how much money companies should be thinking about raising at these very early stages, what are your thoughts?
Yeah, I mean, I agree. I agree with what Pam said. There's just no template for that. It's more about what it is that you actually are trying to achieve. So I think the biggest mistake you can make is to decide how much money you're going to raise and then design the plan around that. That's the wrong way to go. You should be thinking about what is it that I need to prove, and what do I need to do to get to a point where I can raise more money. And then you cost out that plan, and then you raise that plus a little bit extra, because it's always going to take longer and be more complex or start and stop. So I do get nervous when I hear people talking about, well, we're going to raise £1 million or £2 million, and you say, well, okay, talk me through the use of proceeds, and the logic is kind of back to front. So I mean, ultimately, whether it's pre-seed or seed funding, you need two things to succeed. One, you need whatever technology or science you're working in to work, or at least show that it's going to work at some point. You're making progress towards having something which may be of value. And the second is that you are going to be able to continue to fund that technology or those assets or whatever it is that you're working on. So pre-seed funding is not grant funding. I think it's slightly more it's different when you talk about angel investing. There's obviously a difference between people individually investing and a government body or a grant funder. I think from a LifeArc perspective, we are clear that either you take grant funding or you take pre-seed seed funding. But if you take pre-seed seed funding, you understand that actually you're committing to build something of value over the longer term. And so what that means is that that's the first step in that funding journey. And you need to think about how you're going to manage that funding trajectory over the longer term. So I think that's not an answer as to how much you should raise, but it just helps to sit down and think about, okay, what is it that I'm trying to do? If I'm trying to build a company that's going to have some longevity, then I need to get to a particular point, and then another point, and then another point, which demonstrates an increase in the value of my company. How much I'm going to need to raise at each point, and how am I going to build out people around me that have that are like-minded, that have similar conviction levels around what I do, and also have similar investment horizons. Because there are funds that have short horizons and some that have very long. And if you are in a long game, then you need to have people around you who don't need the money back in 3 years.
Barbara, could I just add to that? I totally agree. But what you'll find is a bit of pushback from people like us, that if you say I'm going to get to point A by the end of 2022, and therefore I'll need the money for that. Absolutely, you have to link it to the plan. Often we'll say that is too ambitious. You'll run out of money on the way, which is the reason we sometimes say raise a bit extra, because we can see that there's no way you're going to get there. So be pragmatic, don't over raise, but don't under raise. That's helpful, isn't it? Make that judgment.
I think that's a very important point, isn't it? Is that, are you raising enough? Because things always take longer and cost more than you anticipate. Yeah. I think Claire raised a really interesting point, which is this point about having an overarching strategy. It's not about doing this raise now and then think about the next raise in a year's time. It's really about having that long-term view of what are you trying to build, and what are the different steps along the way, and what are you going to need to do that. So my question for discussion is, okay, so what about the compatibilities or incompatibilities of different kinds of investors? So if you start with seed investors, how compatible is that going to be to bring in venture capital at the next point? Pam, would you like to talk from the point of view of an investor? You've obviously been invested alongside VCs many times. How has that worked?
Yeah, there was a question from an audience member about investing alongside, and yes, we do it, and it speaks to a point I probably should have made, is take money from people you like. Don't take money from people you don't like. I know that's some of you will say we have no choice. It's like saying only go and work for somebody you like. You do actually have a choice, and find out about the VCs. The answer to the question is, I do invest alongside VCs, but not every VC. There would be some I would avoid, you know, the rapacious vulture capitalists. It's a judgment about people who've been angel investing for a while, get to know who's a decent VC to invest alongside, because not only do the bad ones take advantage of you as founders, they take advantage of us as angels who've taken the risk at the beginning and don't benefit on exit. So I think I would say that it depends, but we definitely do go alongside VCs. Yeah, and university funds, which of course I should have mentioned. If any of you are spinning out of a university, go to the TTO, the Tech Transfer Division. Barbara and I work with Cambridge, which we think is a good one. They don't take too much equity, but do ask them as well for some pre-seed and seed funding. Thanks.
And Claire, thank you, Pam. That was really helpful. Claire, I mean, from your perspective, so what's your perspective of investing alongside A, business angels, and B, other investors? I mean, what's your kind of syndication philosophy, I guess?
Yeah, I think the data points we have are within our own seed fund portfolio at the moment, and I think that we know how challenging it is to raise funds when you're a young company, and so we would just be very welcome and very open to co-investing along people who have some experience in doing that in this area, because I mean, as everyone on the call knows, it's life sciences has its own foibles and particular ways of working. So yeah, from a co-investment point of view, I think we don't have an opinion one way or the other. We want the companies we are involved with to be able to raise capital. We want to be good corporate citizens. You know, we want to play our role in the UK infrastructure. So we would welcome all of that. I think just one point to note is that for in particular companies in really hot areas, when you reflect back on this topic that we brought up at the beginning of the call around some of the big investors moving earlier and earlier, you might have to make a compromise around this idea that if you're in an area that's going to require substantial amounts of capital, really substantial, then you're going to need these big investors around you, and they have a different way of working, you know, and they want some control, and that's to be expected if you're raising, you know, an A round of 35 million or a B round of 65 million. You know, you're going to have to compromise, and some of the smaller investors are going to have to budge up a little bit, and that's the price you pay to get that kind of capital and that kind of power around the boardroom table. So I know this is a call on pre-seed and seed funding, but if you see some of the big American investors taking massive positions in small European companies, then those dynamics are going to play out, and that's not a bad thing. You know, if you're the one putting in 30 million into a round, then you're going to want to have a level of control.
So we've got a question actually from someone who's from a therapeutics perspective, and he's basically asking, you know, obviously there are issues for therapeutics because a small amount of seed funding can only take you so far, and you really need to build that data package if you're going to be able to raise that substantial amount of seed funding. I mean, I guess one point is look at grant funding. I mean, I think that's always going to be a good opportunity. But I think it is for therapeutics, there is a challenge, which is that you do need substantial amounts of money. I'm going to ask Perry to come in here because so I mean, perhaps you could talk a little bit more about the biomedical catalyst. And there's also been a question about if you have a SMART award, does that mean that you can't apply to the biomedical catalyst, or is that still a possibility?
Thanks, Barbara. I was literally just typing the answer to that one, so that's fresh in my mind. So I'll do that in reverse. Yes, you can apply for the biomedical catalyst if you've got a SMART grant under a certain number of conditions. Obviously, you can't get funded twice for the same project. That goes without saying. And there are certain restrictions about reapplying to Innovate UK for grants. So just so people know, it's possibly not the case for the person that's put the question forward. This is a general answer. You only get 2 lives with Innovate UK generally. So if you submit to any of their mechanisms and you're unsuccessful, you have one more go at submitting. And if you've submitted twice, you can't resubmit. It's their way of managing demand and managing expectations. You can put in a material change. If there's something significant that's changed in the project, you can reapply as a consequence. So the answer is yes, you can reapply to that. You can apply for both SMART and biomedical catalyst. There are others that you can't. So we haven't talked about it today, but Eureka Eurostars, which is a fantastic international collaborative mechanism, same as SMART in terms of open, same as SMART as in terms of early stage applications. You're only allowed 1 live project at a time. It's just their rule. It's very different. But yeah, I would say in terms of the complementarity, grant funding can really support you, as you just said, in terms of putting them next in parallel to make sure things happen throughout the whole stage of the project development.
Great, thanks. Okay, well, there's 2 more subjects I'd like to cover if we can in the time that's remaining. One is around valuation, which is a perennially interesting subject to founders. And the other is around the management team, which I think is obviously absolutely critical, as I think you've all alluded to. So let's take a look. There was a question on valuation, and the question was around, what valuation methods are most widely sort of thought about. Yeah, I think valuation there's a lot more to valuation than just the method that's used. I mean, I think everyone will have some comments on that. Pam, do you want to start off around how founders might think about valuation? And
can I go second? Because I was going to say my technology is like that, and I know I shouldn't say that, but I want Claire to kick off, and then I'll follow, because it's very, very difficult. It's very arbitrary. But Claire, you go, and then I'll follow. Sorry.
Yeah, sure. Yeah. So I think if you think about, if you start with bigger companies, so typically you would look at things like transaction comparables. So has a company been sold recently that is similar to your company, or has a company that looks similar to your company done a NASDAQ IPO, and if so, what was the price that it traded at? Even then, you need to do very careful analysis of what we call sum of the parts valuation, which is that you need to break down the company by its program or by its assets, and most people would attribute value to each of those different types of programs. So you can't say that my company is, pick any, focusing on a particular therapeutic area, and this company floated and they're focusing on that area, but actually that company has a phase 3 program and I have a phase 1 program. So you're not comparing like for like. So be very careful about saying that you're similar to a NASDAQ listed company, because investors will say, well, you're not actually, and then you lose a bit of credibility. So just watch out when you're looking at transaction multiples and transaction comparatives. Obviously, there's the sort of theoretical probability risk adjusted net NPV analysis. So you can do all sorts of really interesting analysis to look at long term over the course of getting this drug, for example, on the market. You can do a full sort of cash flow and NPV analysis and then discount that back. Again, you'll have investors really challenging you around some of the assumptions around market size, market penetration, pricing, reimbursement, all that kind of stuff. So be ready. If you're going to do that, it's great that you do that, but you're going to be heavily challenged on those things. So, and again, those are all techniques that you use for companies that are a little bit more developed. So if you're just spinning out of an academic institution or a university, you're probably not going to have any of that stuff. So you're really looking at trying to have a negotiation between the people providing the funding and yourself around how truly innovative is this technology. So is there a value in it because it is innovative and new? Do you have IP protection? Is that absolutely clear? Are you an outstanding leader in this field, and therefore is there weight in, is there value in you and your team's contribution to the business? And ultimately, I mean, Pam will probably talk about this some more, but it is literally just a discussion on a mutual agreement around the perceived value of your innovation. Again, that's not really
No,
very, it's not very specific, but that's what happens.
that's really helpful. Can I add to that, Barbara? It's great stuff. It is a discussion at pre-seed stage, and it often depends on it will depend on the lead investor. Barbara and I are looking at something at the moment where the valuation, our eyebrows went up into our hair, and we think, how on earth, we did say, how on earth did you get to that? Other company founders are on the other end, not so often, but the lead investor that might be another angel or an angel group or a VC generally sets the terms. And as an angel, you're an individual angel, you're waiting for that valuation decision, which, as Claire says, is the result of a back and forth between the founding team and the lead investor. And it really is a finger in the air sometimes. I know I shouldn't say that, and it's not very technical, but it sometimes is. Now, I agree with Claire, at early stage, it's IP, or in my world, there's often not IP, it's software. It's the founding team and the speed that you judge that they will be able to get to the market and dominate, or certainly have traction in the market. So it's speed to the field, and that comes back again to the founding team. But the end of what Claire said applies to my domain of pre-seed and seed. It's absolutely a to and fro between the lead investor, investors, and the founder, and what you can get. And I think, Barbara, you might add, don't overvalue, because it will compromise your ability to raise at the next round.
Yeah, I mean, I agree. I mean, I think we see this, don't we, Pam? I mean, basically, obviously, it's understandable that founders want to push for the highest possible valuation that they can. But actually getting an investor that is kind of a bit soft and that will allow that very high valuation in your first round is actually not necessarily doing you any favors, because it may actually make your next funding round extremely challenging. And the last thing that you want to have is a down round. But I think let's move on to the final subject for discussion, which I think is a really important one that everybody's alluded to, which is actually the people, the team. And I think, everyone's mentioned that, you want to have the right team executing, or you've got to show you're the right team to execute on this particular opportunity. And I mean, in fact, every single person has talked about the importance of the team. So I'd like to ask everybody, how do you actually assess the management team in these very early stage opportunities? So how do you assess them when you're making your investment decision? And then how do you assess them on an ongoing basis? And Perry, I'll come back to you, because I think management team is a very important criterion for grants as well. So actually, why don't you start off this time? So why don't you give a start off of how important management team is regarded in grant applications?
Okay, I probably would have been better last, because I'm going to have to slightly twist the question, because it's not how we view a management team, it's how we view, or how funders, I should say, view the team capable of delivering. If you remember my point earlier, it's about the fact that you're addressing a key problem that is technically challenging and highly risky. That's why you're going for grant funding, because it's a difficult space that we're trying to fill. So we have to look upon the expertise within the team. And we always use the term, what is your dream team? Is it the team within your organization, and you've got all the elements, you've got the technology, the technical brains and the scientific brains and all the other right assets that will enable you to deliver against those high risk, high technical challenging problems. It's not about natural attributes, it's about capability. What's their background, their experience in achieving so. And if the answer is you're missing a few, that's not a problem, because there are two solutions to that. You either put in that you're going to recruit, which is a risky risk, because then can you recruit that person for the grant? Or the alternative way of doing that is, who should you collaborate with? And there's absolutely no shame in grant world in collaborating with the best. In fact, that's highly encourageable. So you can and should think about, well, who else can I bring in as a partner, as an organization, to work together to create the dream team to enable that. So as I say, Bob, a slightly different angle, because we're not assessing the people, we're assessing the ability to deliver against those high technical challenges and those risks.
Great, no, that's really clear. Pam, would you like to talk a bit next about how you view management teams?
Right, I'm sorry, there's some roadworks behind me. Can you hear that?
No, it's fine.
Okay, good. So I've been thinking about this because my founders, the one I talked to yesterday that I'm interested in is 24 and extraordinary young man, and his co-founder is 28, old. So you're going on, there's a lot of gut feel. And I used to think it's because I was a woman. It's terribly sexist, isn't it? But it's a gut feel about the people involved and their knowledge and their passion and their capacity that you think, you know, you're hoping they're going to work absolutely flat out for this company. And then you make a judgment that there is no track record on their ability to manage teams, because often you get fantastic founders, often medical founders, who haven't a clue how to manage people. So you're making a judgment on that. But it's also, if there's not much IP, it's their knowledge of the terrain. This founder yesterday, the very young one, knew exactly what he was talking about the US health system, which is often in my world not very common. And then Barbara also teachability, willingness to listen. Will they listen to people like me who are old enough to be their parents and their other board advisors? I also look to see, even at a very early stage, have they had the judgment to get in advice? And I maybe should have said that in my initial remarks. You look for the quality advisors they've got. So are they teachable? Do they listen? And are they responsive? Often they will pivot, the trendy word, to a new area with their company. And would they be sort of flexible enough to do that? There's a lot of personal judgment involved, effectively, is what I'm saying.
Great. No, that's fantastic. And Claire, how about you? How do you see the management aspects in this very early pre-seed funding stage?
Yeah, I think that it's so you either have kind of founder managers, or you have a founder manager plus a sort of commercial manager who's been brought in, and it sort of depends on what the company's doing and the way that the company itself was formed. And so I think that we try to take a pragmatic view, because the people that lead an early stage company, sometimes they're not the right people to scale that company up. So we sort of look for different skill sets at different points in development. And so I really value transparency. So people that are, I have had a chief exec very openly say, my job is to get this company off the ground. I know exactly what I have to do. And in 2 years, I'm not the right person to lead the company, because you need someone who knows X, Y, and Z. And so that's really valuable, because it shows that that team is thought about not only, as I said before, the financing strategy, but actually what are the right skills and capabilities that company needs over the next few years. And they've had that discussion internally about how are we going to make sure that we can deliver. And people have just been really honest and transparent about where their own skills fit in that matrix. So I really like that. And I think that on the scientific side, obviously, if you're a scientific founder, then you need that longevity. You need the commitment of that founder over the long term. And we would definitely test that commitment and that level of involvement. But in terms of, you know, the skills that you need at different points in development, I just really value people that are really honest about what they can, why they're there, and what they're going to deliver, and whether they're the right people to be there long term.
Great. Well, thank you very much. And thank you all so much for being brilliant speakers. I hope that the audience has actually got some useful insights and nuggets of information around what to look for in pre-seed funding and all the very different aspects of thinking about that. So back to Jane.
Thank you, Barbara and Perry, Pam. Thank you so much, and Claire too. What an amazing array of expertise there in the room. So thanks for all your advice and a great discussion, wide-ranging, and also segueing very nicely into our sessions that are upcoming. We've got investor perspective next, but importantly, the team perspective this afternoon. So there was a lot about that here, and lots more discussion about that this afternoon, hopefully. But now we're going to move into the one-to-one sessions and the networking. So do hope that you've got plenty of meetings booked up. If you haven't, please do go to the expert area have a good look through and make sure that you make the most out of all of that expertise that's on offer there for you. So thanks once again to the amazing panel. It was really interesting to hear all of your perspectives. And yeah, we'll see you back here at 12:15 on the next Zoom link on the agenda for the investor perspective.
And one last plug, which is that we have the KQ Lab session at 3 o'clock for anybody that's interested in data-driven health acceleration programs. Thanks very much indeed.
Thanks, Barbara. Thanks, everyone.
Bye all. Thanks.